Welcome, welcome. Welcome to Huddle Chats. These are 45-minute monthly chats with industry experts to discuss key healthcare trends. I'm your host, Jared Dashevsky. I am a co-founder and writer of Healthcare Huddle, a weekly healthcare newsletter that breaks down digital health trends, policy, business, insurance, drug pricing for 30,000 plus health professionals, including many clinicians. When I'm not doing Healthcare Huddle, or I guess my full-time job is I'm an internal medicine resident in New York City. In today's Huddle Chat, we'll be talking about digital health funding trends from the first half of the year. And I'm super excited to have the digital health funding expert, Adriana Krasniansky, here with me today. She leads the research team at Rock Health, and Rock Health, if you don't already know, publishes these quarterly digital health funding reports that are so informative, and they're written in like such a conversational way. It feels like it's your friend chatting to you about digital health funding over a cup of coffee. I've been reading these for the past couple of years and look forward to them every single quarter. So if you don't already read them, start reading them. And if you don't know who Rock Health is, they are, I guess, one of three things, or they're one of many things. They are a venture firm investing in early stage health tech startups. They are a nonprofit providing resources and support for digital health entrepreneurs tackling health inequities. And they are an advisory firm providing help to organizations to better understand this very complex digital health landscape. All right, and with me today is Adriana Krasniansky, again, head of research at Rock Health. She leads these wonderful reports. She has a business degree from Fordham, a master's degree from Harvard in health equity and aging studies. And there she was a Petrie-Flom fellow in bioethics, biotech, and health law policy. She has numerous publications, has extensive experience leading projects on technology ethics, community-based digital health programs, and virtual care services for Medicare populations. Adriana, thank you so much for joining me today.
It's a blast and quite the intro, both for me and for Rock Health. So we really appreciate it. Nice to see you all.
Okay, and before we get started, just want to lay down some ground rules for everyone. I mean, everyone should be a pro at Zoom meetings, but please keep yourself muted. If you go unmute, someone on my team will mute you. These chats are recorded and will be uploaded to YouTube for people who couldn't make it today. Emoji reactions are encouraged. My team will post a link for you to ask questions, and we will get to them at the end of the chat. And most importantly, stay curious. And so the way I want to structure this chat is to basically talk about the funding trends we were seeing in 2021 and 2022, because I think that will help us better understand the funding trends that we saw in the past 6 months. So let me share with everyone. So this is the title of Rock Health's report from 2021, and it speaks for itself. That 2021 year-end digital health funding, seismic shifts beneath the surface, literally like an earthquake of funding. So between 2020 and 2021, we saw digital health funding double from 14 billion to 29 billion across 730 deals. Average deal size was 40 million. Adriana, when you guys are crunching the numbers, did this surprise you guys, or were you like, oh no, we expected this?
Well, it's actually funny, Jared, because so that was the title of the year-end report. And I remember at the half-year report, it was one of my first reports for Rock Health.
Oh, really?
I just joined the team, and I remember that the headline was, "What a year in funding in 6 months," right? So we had raised 14 billion just, by July of that year. And so I think everyone was just, a little bit in shock. I think we, of course, we're living in the moment. And so you're kind of watching this happen. It's really hard to see, beyond kind of the quote unquote eye of the storm, right? And so it felt very normal at that point, right? But when you look at the historical numbers, we were absolutely trying to assess at that moment what it meant for the future terms. And so when we said kind of these seismic shifts, not only were we talking about the fact that this funding is kind of like a really substantial and foundational difference, but we were also really trying to figure out what was happening on the ground floor beyond just inflated funding numbers. Right. And actually some of the new realities we'll kind of talk about today already started being established in 2021. They just didn't grab the headlines because the headlines were all about this crazy influx of cash flow. Of course, following broader venture trends, but even relative to the venture market.
Right. Yeah. I mean, at first I guess I didn't read the 6-month report. So I was shocked, but then I saw that across all venture capital, funding was like through the roof. Let's see, 330 billion was raised in like venture capital in 2021, which was like the most ever across all industries. So I guess not surprising looking back that 2021 saw this spike.
100%. Oh, and just even like mention that. I mean, this was the time of crossover. Like this was the Tiger age, right? Like the Tiger's growth equity fund, the Tiger age of investing. And also what I think is really cool and important to mention was, funds were deploying capital at these crazy amounts and also raising new funds, right? So this was a really active time for venture. And we can talk about a few of the reasons why that was, but that also kind of sets up this new environment too, right? Especially because the new funds then closed, depending on when, maybe 6 months to a year later. And now they're in the stages of trying to deploy that capital.
Right, exactly. Well, I guess good segue. So like, let's talk about why funding spiked, like what made it easy to raise capital. I mean, I know interest rates were very low, making borrowing money very easy, but maybe you can elaborate more on that.
Oh yeah, for sure. So definitely, I mean, interest rates, money was cheap, right? And that was there were a couple of things, right? It was cheap for investors, or it was cheap for, individuals who were either investing in companies or for companies who were seeking out investment, right? So because capital was cheap, you just saw more venture activity as well too. It's kind of a kind of self-perpetuating cycle, right? Where if you have available capital to deploy, then all of a sudden you also have founders who are like, hey, there's capital on the table, and not all these investors are going to get into these really exciting rounds, but they might get into my round, right? So it also kind of created this encouragement for startups to come to the fundraising table at that time, or to even pull up some of their prior rounds. So we saw kind of like a lot of scrunched rounds in 2021 to 2022 as, I mean, there's free lunch, right? Like, what are you supposed to kind of do with that kind of component? So that's a little bit just about the investment market. When the investment market's hot, I think a lot of the strategic guidance that founders are given is to raise. Right. We'll talk about some of the repercussions of what that might look like later, or even just some of the headlights that you kind of should be looking for on the horizon when you do choose to behave in that manner. The other thing though was, I mean, this was right as COVID-centered care was at its peak, or COVID responsive care, right? So telemedicine at parity, right? Telemedicine at any modality, kind of some extensions or exceptions made to the way we deliver virtual care that were really allowing for a lot of experimentation. And everyone was looking for kind of a telemedicine partner or a telemedicine solution, right? And so I think we were also watching investors and kind of our financial as well as healthcare industries understand this kind of industry change in real time, right? And so everyone's trying to be at the forefront of that change, which also inflates a little bit of the kind of the crest of that wave. And then I think just the last thing to note there too is that consumers had a lot of money in their pockets, which really changed our D2C landscape. And again, that's not only in healthcare, but several healthcare companies had really strong prospects in terms of their revenue streams for D2C because we had some really captive audiences at home with cash in their, whether that's through stimulus work or just, different relationships to the healthcare system. They might have been delaying some other more expensive, things like a knee replacement, right? But they might have more disposable income to then talk about, mental health, or maybe they had these needs surface at different points. And so direct to consumer healthcare had this really interesting intersection of digital and consumer attention. That then kind of wane or settle differently once that consumer environment changed.
Right. Yeah, I remember like reading left and right and like Fierce News, like DTC this, DTC that. And I also wonder, like you said, like there was like regulation reforms, extending telehealth, allowing it to be reimbursed at the same as inpatient care or in-person care.
Yeah.
And so I wonder what came first, like the innovation from these startups and then the funding, or the funding to these startups to take advantage of like these new relaxed regulations, or it's probably a mix of both, like an equilibrium going back and forth.
Well, this might be also like a bit of a personal perspective. So I wasn't at Rock Health right when the pandemic started, but I was finishing up my master's work. And I remember my thesis that I had been working on was really focused on virtual hospice care.
Oh, nice.
Section, or virtual aging care more broadly, and then also thinking about serious illness care as that intersected. And everyone was like, what is that? Right. When I like started in 2019, right? It's like, I really don't understand how that's a possibility, but maybe
Right.
sure we'll give you a little bit of funding to look into it. But then as my kind of defense came through in 2020, it was a completely different environment. Everyone's like, oh, that's really important. And so I think there are probably several founders, several investors who had similar theses or perspectives, and then all of a sudden had to ramp up to reality. I mean, even as someone who was looking from the outside in at these possibilities, I felt this pressure then to try to navigate a market in real time. And so I imagine for a lot of founders, as well for a lot of partners, it's like, okay, all of a sudden there's cash set aside, as there should have been, right? To try to find parity to deliver all these types of care, that maybe COVID care, as well as all these other types of care that we weren't able to kind of receive in person. But the question is, okay, how do we do that the right way, the sustainable way, the ethical way, the responsible way, right? And I think all those things were pressures on top of just getting a product to market. So I think that it's just it's like an Instapot environment, right? Like there's just a very high pressure environment to try to be innovating or to try to find the right innovation partner.
Right. That makes complete sense. And then when I was like diving into the 2020 report, like we saw like no surprise, right? Mental health, or funding into mental health space, was like 2 times more than any other clinical indication at the time, like 5.1 billion. Again, same question. Like, did you expect to see mental health like completely balloon? Especially with like lack of access to mental health care providers during the pandemic. Everyone was alone. So there was a huge need for it.
Oh yeah, 100%. I think there's a couple of things, right? 100% the need, right? We're still dealing with a mental health crisis that in so many ways was really exacerbated by the pandemic, right? And so absolutely just the need for mental health care services for folks who were receiving mental health care to extend and continue their treatment and support, for folks who may have not realized their own mental health needs, and then the pandemic just brought those to light or maybe created new contexts. Absolutely important. I think it's also really important to note what makes mental health really an important foreground or testing ground for a lot of digital health solutions, right? Especially when we think about a lot of mental health care delivery. Right now in the United States, when you think about your traditional talk therapy, it's well positioned to transition to virtual, or to have a smoother path to some of these digital virtual audio communications. And so I think by and large, from a regulatory front, it was an easier transition for a lot of our policymakers to understand. It's also an easier way to deliver service at a somewhat comparable quality, right? Whereas I think there are a lot more unknowns around things like virtual approaches to different chronic conditions, right? Where outcomes maybe aren't as tested, or the mode of delivery is actually very much modified by a virtual experience. And so one thing I just want to call out is, not only is mental health so important in the United States and globally that it like really came to the forefront during COVID, but it's also a very applicable space for kind of that first level digital transformation, right? Taking what you do in in-person talk therapy and bringing it to virtual talk therapy. Things like serious mental illness, things like substance use disorder as it intersects with mental illness. Those are the areas we're really seeing now come into fruition with a lot of innovation, because they aren't that just first level transition. And I do think that kind of compounded what we saw in 2021.
Right. It's like in 2021, we saw like the proof of concept, like we can do talk therapy virtually. And now we're slowly going into like these more complex related conditions and mental health conditions. So I'm
Yeah.
excited to see.
Oh, sorry. And talk therapy is one really important segment of mental health.
Oh, sure.
It is not to say a close segment. There are so many other types of care that needs to be delivered in a behavioral mental context. And I think that's also why we're seeing some challenges in the space now, right? In the sense that there's only a certain TAM, right, for basic talk therapy, basic kind of talk therapy modified by SSRIs or those kind of components. And so at the end of the day, serving those patients is really important, but also scaling up what we can do in mental health is really important as well. And that requires sometimes a different modality or a different type of digital approach.
Yeah, definitely. All right. Yeah, great response. And before moving into the 2022 trends, in the article from 2021, quote, is digital healthcare in a bubble? Rock Health has been on bubble watch since 2019. I just thought it was interesting. Like that was already like on the front of everyone's minds from the get-go of 2019. Not sure if you have any comments on that, but I just want to highlight as you see what patterns follow.
Yeah, I mean, well, at one point, right? Well, we published, we got asked a similar question in 2018, 2019, right? Is digital health
Okay.
possible? So it kind of goes to show you that anytime a market's moving upward, even possibly, you know, relative to the rest of the venture trends, folks are like, well, is that actual change or is that something inflated, right?
Right.
And we have a couple really interesting parameters we track around that, right? We track things like how are clinical outcomes kind of tracking alongside or publishing of clinical and commercial outcomes tracking for some of these companies. We look at things like what are the median deal sizes, right? Just to give us an idea of like the maybe stability across a cohort. We'll look at things like exit outcomes and possibilities. We'll look at things like regulatory work. We'll look at things like, you know, considerations or concerns around behavior like fraud, right? Those are all things that we might see heightened or changed in an inflated environment. And so I'll give a big kudos to my colleagues, Sean and to Sari and Bill, who wrote that in 2019 and also did a recap of that in 2021. But I think the other thing just to say is venture is both a leading and lagging indicator. And that's what we hold at Rock Health, right? Investors oftentimes see a lot of really important writing on the wall and invest in the companies that are best positioned to change our status quos. But at the same time, you're also seeing investors really get excited by other investments. They don't want to get left out of an area. They don't want to lose an opportunity to be in a really important round, right, with a certain company. And so there can be a bit of just circular behavior that we know a lot of really smart investors have perspectives on how to manage, but inherently the industry kind of feeds itself, right? Like, hey, mental health is hot. We should probably invest in mental health, right? That's a hard challenge to hold as someone, again, who's trying to parse through the data in real time as an investor.
Right. Yeah. The writing was on the wall for mental health. So, all right, moving on to 2022. This was like a segue. Companies that take in capital without investing in infrastructure, business model innovation, or talent and leadership are headed for tough future quarters to meet the expectations that come with high valuations. And in 2021, everyone was valued very high. So here we move into 2022. Digital health funding reached 15 billion, so nearly a slash and half across 579 deals, and the mean deal size 26 million, so like 13 million dollars left. So sorry, I keep asking, are you surprised? Did this surprise you?
Honestly, I think that quote says it well. We're like, hey, it's going to be a little bit tough for folks or startup founders, startup teams, right?
Right.
That raised in this really hot environment, got great, really founder-friendly terms, right? Got great valuations, which of course is so important when you think about the equity you hold and what that's worth and your path to exit. I think a couple of things to call out. One, the exit market is, I mean, and it was partly because of what happened in 2021, just really dried up in 2022. And that again, wasn't just in digital health, but a lot of these companies that were like, I'm just going to ride this wave to the, not to the sunset, right? But to the sunset of public market behavior, right, where then there can be some adjustments. Watch some of their peers that do that and have really bumpy roads in 2022. a big story in 2020 was just how hard it was for some of the companies that exited in 2021 to kind of get their bearings, with public market analysts, with, the broader stock market. And so the exit pathway wasn't so enticing in that sense. And then it was like, okay, well, if we have to raise cash, but we're not likely to kind of have this wave go the same way, at what valuation do we raise? How do we start to have these conversations? And so one thing we really talked about in 2022 was how much that was kind of catching up to later stage players, the ones that were probably trying to get into that exit window. I think now the story is a little bit more so what this quote talks about, which is, well, what does that mean for the Series A and Series B players who raised at higher valuations, who probably aren't close to exit in a public exit sense, but they still have to start proving commercial outcomes that kind of relate to those really high valuations they had. And so I think for everyone, it's like a reset, but the reset hits some of the later stage players first.
Sure.
And then but it's going to be across the market, which is something we were already probably calling out in 2022.
Right. And now, like when we get to 2023, we definitely see those effects. But for 2022 funding, I want to highlight some of the where the money is going. One thing I nerded out about is non-clinical workflows. So I have a background like systems engineering. So anything that has the word workflow, it just excites me. So I was very happy to see this make one of the top rankings for funding. And I think, and we'll talk about this next, but with the advent of natural language models, natural learning or artificial intelligence and ChatGPT, the possibilities are limitless for using workflow to improve operations in healthcare. But any of these trends stick out to you in regards to where the money was going in 2022? Obviously, mental health is no surprise that it stuck with number one again. But anything else?
Yeah, I think non-clinical workflow is one. I mean, it's high up this year as well. Yep. It's something we're watching. And what I really am interested about there, especially related to the two around it, R&D and then treatment of disease, is for R&D in particular, right? For an R&D solution, there's a high level of upfront costs that go into developing the right product and making a kind of a product that's defensible, has a strong moat, really is differentiated in the market. Even same for treatment of disease, which is where you see things like digital therapeutics, right? Where there's a lot of upfront costs. And so high raises there are pretty important, right? That's where you're really seeing some of the new components. Non-clinical workflow in the past, prior to 2022, you saw kind of lower check sizes for overall for the category, right? This isn't just early stage or just late stage. And that's because the SaaS options here at first were not limited, but it would be things like, the right intake form or the right RPM solution or the right kind of support for the prior authorization. But what I think this kind of tells us, one, is that there's definitely more of a need, right? Mm-hmm. And so we just see that kind of leading and both lagging indicator as we hear from health systems, as we hear from payers, how important, focus here is, as we have policy pushing us to make this data more interoperable, to streamline this and, this approach. This is one of the categories that benefits from kind of all of those signals in the market. The other thing is we're kind of seeing non-clinical workflow solutions grow in their complexity, right? And this is where we are seeing things like AI integration. We'll talk about what types of models might either be integrated, where a proprietary model development might make sense, those kind of things. But you might see, and we are expecting to see some of these non-clinical workflow startups really position themselves more in that proprietary technology mindset, right? Where they're interested in raising bigger checks to start as part of their product development. That's a risk, right? Because at the end of the day, proprietary development here, the returns might not be the same as discovering a new molecule, right? That then goes on to become this blockbuster drug. But it's interesting to me to watch not only the market need, but the technological complexity that goes into these solutions.
Yeah, that was great. Great answer. It gets me even more excited about non-clinical workflows. And so I just wanted to show you what the funding looked like from 2020 to 2022. Just now you see a little spike and a dip. So we talked about interest rates in 2021, how it was very cheap to borrow money. 2022, we have inflation. It's definitely not cheap anymore to borrow money. But what else were we seeing, the reasons for this decline in digital health funding?
At the end of 2022, we really kind of talked about maybe this was the bit of the end of the cycle, a cycle, right? And so I think that's also what you're seeing is a bit of an adjustment to a different reality, right? Like we had a really concentrated experience in particular around COVID in healthcare, right? And I think folks try to press me or the team to say, is that good or is that bad? Was that right or was that wrong? It's the reality, right? And it makes sense for what we as a nation were going through and the types of solutions we wanted to bring to market to serve patients, consumers in that moment, right? But after 2022, we realized that there is a different and new reality that's being created in healthcare. And that's not just by health systems and organizations deal with digital. It's also related to things like how regulators see the market. It's kind of related to the ways that how consumers view these solutions, maybe a status quo and not something that they're really necessarily going to pay a premium for or seek out of network for, like in a direct relationship. And so we kind of saw this as a bit of an adjustment period. And we noted how rocky it might feel, primarily for funders. Or excuse me, for founders, but also for funders. So we kind of saw this as the second half of the bell curve, if you think about it as bell curve's not the right distribution, but the second half of like a little cycle, right?
Yeah, looks like a bell curve. So, and then one thing I want to know is that in 2021, we mentioned like direct to consumer was like taking off, but when you have high inflation and consumers don't want to spend money, like spending $150 on a comm subscription, like you may avoid doing that. So direct-to-consumer companies also took a hit in 2022, and like the shift like back to B2B was being like mentioned here and there.
Yeah, and I think there's probably like a few different components of that. One for sure is just consumers are reorienting their spending priorities. The other thing is, of course, Apple's changes in privacy settings. Or their consumer data sharing really changed customer acquisition costs, right? It changed the way that a lot of the platforms that advertised a lot of these D2C players could reach prospects and acquire customers. So the CAC. I think the last thing is just the maturity of the digital health sector meant that more organizations, right? Your employers, your insurers, your healthcare providers were adopting digital. And so it might not need to go direct to consumer, right? If you're going to get calm through your employer, you're not going to pay through a D2C subscription. And so companies like that really shifted their focus. So I think those things kind of worked in tandem. And I think it would be a little bit incorrect to say it's all in the consumer's changed behavior. It's also probably a change of how the market viewed the consumer as a buying agent and probably deprioritize them for digital solutions.
All right. I like that. And so now moving on to 2023, the most recent report, 2023, a new funding cycle. Second half of 2022's quarterly average, this is from last year, 2.4 billion may be a bellwether for the next several quarters, which means that 2023 could be digital health's first 10 billion or lower year in venture funding since 2019. And then with the latest Rock Health report recapping the funding trends from the first half of this year, we see that perhaps it is on track to be the lowest funding year since 2019. So within 6 months of 2023, 6.1 billion across 240-ish deals with an average deal size of 24 million. So when you guys were crunching these numbers, I did see that mega deals were kind of pulling the average up. And there's a lot of mega deals, 12 mega deals that exceeded the median deals by more than like 200 million or 20 million, which is quite a lot.
Yeah, and a big kudos to Maddie and me here, who were the primary authors on this report. I'm mostly just parroting and sharing the really smart data crunching that they did. What I want to kind of call out here, which I think you're 100% right on, is we'll probably end the year in the teens, low teens. I mean, it's to be said, funding tends to be cyclical, right? And so Q1 and Q4 historically are kind of sometimes where we see a lot of investment. That's across venture, right? It's, the venture summer, right? Whatever you kind of want to call it. But this year in a new funding cycle could look very different for us. So that 10 billion might not be the case, but it likely will be lower. When we talk about what's happening with mega deals, I think that's really important to call out, which is that the funding numbers that you're seeing overall are really being skewed by outliers toward the kind of 100 million plus check size kind of component. And what that tells us is the baseline trends are probably very different or a little bit different than what we're seeing. But we kind of had this internal struggle of, okay, well, we can't call out the baseline relative to these because these are part of the story, right? Like, are they skews to the data or are they the data, right? And I think the reality is probably the second. But we're really interested into why we're seeing so much mega deal activity in an otherwise lower dollar value, lower deal volume, lower investor participation market. And our hypothesis is that we're seeing, active investors in the space, folks who know digital health, kind of making some bigger bets in companies that they feel are the most, quote unquote, the most, or some of the most promising in the market, right? So we're seeing less of this diversify your investments by making several small bets in a lot of different companies, some of which might be, competitive or similar to one another, whatever that looks like, right? Or might be more similar into more of, we're going to really make a bigger bet here because we feel like this company will be a winner. And so there's a couple of things to unpack there as to what it means to kind of focus on certain investments rather than kind of taking a diversified approach. But that's our hypothesis as to why we're seeing this mega deal behavior separate from just like these lower overall funding trends.
Right. So these investors are basically like double down. They're like double downing on like what they feel extremely confident will succeed in the future and like get the best return of investment instead of like diversifying their investments. Is that correct to say?
Yeah, I think so. And it does depend on also who's writing some of these checks, right? So you have your Andreessens and your GCs being some of the bigger leaders here. And so also their funds are larger, right? So it's not necessarily they're putting more of their money relative to the total fund, but they do have the leeway to maybe write some of these larger checks, and they're doing so actively. I think it's really interesting also just to look at the intersection of what they're thinking of as promising startups, right? It's a combination of the type of company, right? Where is it focusing? Things like value-based care enablement, hospital at home. They're also looking at things like the founding team or even supporting the design of the company, right? Some incubation like exercises happening here where the VC's really involved in getting the founder into the company or helping connect to the first pilots, right? So it's almost like establishing some guardrails to help pave the path for success. There's also definitely components of kind of what the technology is underpinning some of these, right? Is there an IP play that those founders have? Generative AI is certainly one component that we can talk about there, but also biosensor technology, also, just smaller sensors in general and more effective algorithms. Doesn't have to be generative.
Yeah, for sure. And then I just highlighted where the investment of these mega deals were going, what types of companies. And like you said, it was value-based care, it was workflow, it was on-demand health. On-demand health, we're also seeing like incumbent insurance companies and incumbent companies like CVS move into the space as well. Like CVS acquires Signify, United Healthcare or Optum, like just acquired Medicis. Like everyone's moving into this like home health space. So the trends are moving that way as well.
Yeah. And I'll just also clarify for any like regular readers of Rock Health, we tend to refer to the third as more like care at home, health at home, just because some on-demand can still be telemedicine, like what you would consider the Rose of the world, right? And I think where we're seeing some of the bigger bets now are more in that care, like a Signify-esque kind of company, right? Where it's like coming to the home or using the home as an alternative care setting. Definitely where we're seeing some of the more recent activity.
Yeah. And quickly shout out my colleague, Blake Madden, who writes the Hospitality Newsletter. He's always talking about home health and these like huge acquisitions. So I think Blake's on here. Follow him. And then again, workflow makes me geek out. I recently covered and did a virtual event with Glass Health's co-founder, Derek Paul. But I put this map together when I wrote this article on like, what has happened since ChatGPT launched in November? And we see like a bunch of these new companies launch, like Deniify, who's working to streamline prior authorization process, Dotphrase.ai. And we have existing companies like Glass Health, like launch these new solutions that incorporate like natural language processing and these chat GPT-esque solutions. Nabla just launched Copilot. and then huge partnerships between like HCA Healthcare and Augmetics, Epic and Microsoft. So everyone's like moving in to this like workflow space and trying to incorporate AI. And I believe you said you wanted to say something about like the integrative AI.
Yeah, I mean, so this is an area that like I genuinely love and have loved even, before coming to Rock Health. I think the biggest thing, and I know folks know this, right? But it's such a good reminder that generative AI or any kind of large language models have been prevalent in healthcare now for several years, right? We had like the Winter Lights of the world and these NLP players doing great work, even prior to the pandemic, right? We had computer visioning really driving some of our radiology work prior, right? What I think ChatGPT has really done is create a shared language and understanding for us of, okay, these are the possibilities that can be done here. And they've really changed market dynamics, right? So you see large players like Epic making a stake in the ground that this is going to be something that they're going to integrate meaningfully. What that will look like is really up for grabs. How it changes the startup market is definitely, to be determined too. I think it also pushes regulators, which is really great. So we see the FDA kind of having some initial conversations about how they might or would regulate a generative AI model rather than some of the rule-based models that they really focus on in terms of their authorizations and approvals right now. And so to me, this is like, it's a really great education and maybe even marketing standpoint, right? When we think about the future possibilities of AI. But I always just want to call out and celebrate, especially the startups that have been working in some of these areas now for several years, and are now really having to grapple. Do they continue using their proprietary model? Do they think about an integration of a model? What is the best longer term operational pathway for them, right? To minimize some of their tech management costs while focusing on commercial strategy, while also being differentiated, right? So like definitely a lot to play if you're a founder here.
Yeah, very good point. And thank you for plugging that. And then I know we're running out of time, so I'll try to get through this quickly. But in the article, Mihir and Maddie noted like these unlabeled fundraising rounds. Can you elaborate on like why someone would go through an unlabeled round and why we see like a huge spike in it among startups that raise post or during the pandemic?
Yeah, 100%. So unlabeled rounds are kind of both, it could be a strategy that a startup uses. It's also partly a limitation of anyone's kind of publicly available data, right? So usually you will see a startup when they announce a raise, be like, hey, this is our Series A, B, C, or this is, a growth, an equity round, whatever the case is. And sometimes, especially in 2021, that came with, raised a B at, let's say, 40 million, valued at whatever X, right? And why that's really helpful is like it kind of sets a public kind of market precedent of, okay, what this company is worth, what the trajectory is, and gives some confidence to, where that company's headed. So that's one kind of goal of a round, right? Is to give confidence to the market and signal to the market how a startup is performing. The very other tangible and necessary part of a raise is to get cash in the door, right? For operations, for sustained growth, for paying incredible staff, for, supporting technology development. And so I think we also now have this challenge where companies really need to get cash in the door. They really probably have to have a conversation to adjust these valuations because they're creating expectations that honestly probably aren't good for the startup, but they're still dealing with like this press and how they position themselves and signal to the market challenge. And so an unlabeled raise is an opportunity for, or it might be a path that a startup chooses when they want to bring money in the door. They want to kind of either open up for another fundraising round, but they might want to label that round. So this could just be a convertible note. It could be an extension. It's often a bridge round, whatever the case is, but they just won't really focus on it as being a market signal. So they won't, label it. They won't name it as such because they're not really ready to have a conversation about, okay, we raised our A here. It's probably a really high evaluation. We're not really ready to have the conversation about what that means for our B, but we do need some cash to get in the door to kind of see to the next side. Again, there could be more behind the story for any unlabeled raise. We're just going off what the market signal is based on how that raise is communicated to the market.
Right. All right. Thanks for that clarification. And I know we're running out of time, so I'm going to try to weave in the questions people are asking into what I also wanted to finish talking about. So looking ahead, though challenging, tough times can serve as a much needed market correction, right-sizing innovator and investor expectations for a more steady and sustainable future. So a couple of things I want to talk about. First is, what do you envision happening? Like, what key trends for the next part of 2023? Is it like increased mergers and acquisitions? Is it increased mega deals into like these few companies versus, you know, a bunch of other companies getting more funding? What do you think from that aspect?
Yeah, and I'll be short here. One, it's really hard to say in today's market environment because behavior has been so different than maybe like the pattern we've seen the past quarters. I think one thing I am pretty expectant on is additional mergers and acquisitions. We know companies are getting bids in addition to their term sheets. We think a lot of that challenge right now is around valuation mismatch, right? They're trying to figure out the right price to get acquired for. But we also know a lot of startups might be really exhausted from fundraising in today's environment. And so even Q4 of 2022, we're like, hey, acquisitions, we expect them to be picking up. We think it's a good thing for the market as a whole, even though it's a very hard conversation to have. Haven't seen that just yet, right? But we do think something's happened behind the doors as well.
Right.
So I am still watching. I personally am still pretty expectant, but that is just something I'm thinking about.
All right, makes sense. And then one thing I want to bring up, which I haven't seen Rock Health cover just yet, but is like this metabolic health space. Like, we have the advent of these GLP agonists that are, you know, completely changing how we manage obesity, overweight, type 2 diabetes, and as drugs like Ozempic and now like tirzepatide is going to get FDA approval, as these hit the market and they become more available, do you expect to now see, I don't want to like label it now, but like, do you see like the weight management market or this metabolic health space becoming like the next mental health bubble? Not bubble, but like mental health trends that we've seen?
Yeah, and I
like,
will plug that. I'd like that's an interesting analogy. We did write about the metabolic health space just recently. So colleagues Sari and Camille wrote a great piece on just what's happening in obesity care, how digital innovators should be thinking about it. The market size for the market possibility for digital health solutions in weight management is really high. Particularly because we have a lot of these new therapeutics. We have like an untapped market that might not have been available to support or couldn't have been supported through other kind of traditional approaches that now could receive care. So that's a really good thing. I think the analogy fits in a sense that we think about like, what is the baseline level of treatment and support? And digital can be a really good way to increase accessibility to kind of straightforward conversations about medication access for the right cohort of people. I think broadly as a team, we're really thinking about equity concerns here, regulatory possibilities, and that'll probably lead to the V2 at some point, right? But right now, I think we're definitely in a really interesting V1 of accessibility.
Yep, for sure. I completely agree with your equity standpoint. That's like one thing like I'm very worried about is like, right now, insurers aren't really covering it. So who's going to be able to get it? Is the people who can afford it out of pocket. And given it's like low-income populations who are most affected by obesity, like, are they just gonna be left in the dust? So it'll be interesting to see if even Medicare and Medicaid add these drugs to their formularies for obesity. And I just want to plug, it's like, I think depression affects 20% of Americans, not including other mental health conditions, and like obesity is like 40% of adult Americans. So there is like a huge market.
And also, you know, what is the best path to care for folks who have different underlying related components of their weight journey, right? Or their cardiometabolic journey, and really thinking about how digital, in-person, community-based care, as well as nutrition, precision medicine, all of those things are super important to helping an individual manage a lot of the health conditions that relate around this. And so I think what I'm really excited about is the ecosystem of care that evolves around these types of solutions. And I expect that that's honestly what payers, providers, and regulators will want to build as well.
For sure. Right. And I already know like some startups that are making these like all-encompassing solutions that are like anti-obesity drugs, but it already also has bariatric surgery and counseling and you name it. Like, it's very integrated. And then last question before we have to close out. which is a good question. So again, I'm the workflow geek, but will these non-clinical workflow companies, will they be like their own like full-fledged companies, or will they just be point solutions? And I know then we get into the whole mindset that like, oh, these are just so many point solutions that they're overwhelming for health systems to like partner with.
Yeah, I think the one thing I'll say there is like the point solution to platform tension happens all the time and it tends to swing, right? I think we're at a point right now where we see a lot of, let's say for health systems, right? Whereas I think a lot of this really sits, and sometimes for payers too, is they want solutions that deliver against their biggest pain points right now, right? And so a company that can prove that ROI, right, and deliver the highest possible art, which sometimes is a point solution, right? Like, hey, we can help you manage staffing. We can help you with your frontline, supporting your frontline staff in like note taking, right? Or like whatever that looks like, documentation, or we can really help make this prior authorization process less miserable for your payer, or excuse me, for your providers. That's really appealing right now, right? Because there are certain pain points, staffing, budgeting, burnout, that are really important for us to talk about. I think down the road, right, it'll make sense to build them into ecosystems that work together. But at the end of the day, like I personally think we have to respond to what our providers need right now, not so much think about the most elegant solution. Again, that's my end of one thought, but super happy to talk about it.
It makes complete sense. Makes complete sense. All right, Adriana, thank you so much for joining me today. Thank you, Raquel. Thank you to me here and Maddie for writing that awesome H1 2023 Digital Health Funding Report. Thank you everyone for joining me today. This will be recorded, uploaded to YouTube. I will send out a link later. And you can subscribe to Healthcare Huddle to learn more. And Rock Health also has a digital health newsletter that sends out every Monday that you should also subscribe to. So thank you very much.
Reach out to us on Rock Weekly or our Rock Health LinkedIn. We'd love to connect. I'm super happy to chat with anyone.
Thank you everyone for coming. Thank you, Adriana.
Thanks.